Welcome to the Deep Dive. Today we're digging into Telia Company's Q3 2025 results. Quite a bit of action after these came out.
Oh yeah, the share price definitely liked what it heard.
It did. We saw, a 4 or 5% jump? So we're here to break down why, focusing on, execution, cash flow, and where the strategy is heading.
Exactly. And coming into this, the big question really was about delivery. Could they actually deliver on free cash flow? Were they serious about trimming the portfolio?
And the markets seem to think, yes, they are.
Unequivocally, yes, I'd say. That reaction was all about credibility regain.
Okay, so let's hit those headline numbers that got things moving. Operationally, maybe not earth-shattering, but definitely solid. Adjusted EBITDA came in at SEK 8.458 billion.
Right, which was just a hair above the consensus around SE 8.45 billion, a slight beat.
But revenue, that was interesting, reported was SEK 19.861 billion, down slightly, but like for like.
Like for like, which is, what you really want to look at for underlying health. That was up 1.1%, and service revenue, crucially, up 1.0% like for like.
So the core business is growing, even if reported numbers look flat.
That's the takeaway. The organic engine is still ticking upwards, but really the cash story, that's where they really score points.
Ah, yes, the guidance changes. That seemed to be the main event.
Totally. It was a kind of 1-2 punch. First, they raised the full-year free cash flow outlook, bumped it up to about SEK 8 billion.
And that was up from, 7.5 billion previously?
Exactly. And then second punch, they trimmed the capex outlook for the year, took it down to roughly SEK 13 billion.
Which was a full billion SEK lower than the old SEK 14 billion forecast.
Right. So think about that combo. $500 million more cash coming in, $1 billion less going out on capex.
That sends a pretty strong signal about financial discipline, doesn't it? Something the market's been waiting for.
Absolutely. And you saw that discipline flow through to the margins too. Adjusted EBITDA margin expanded nicely, 140 basis points year over year.
Landing at 42.6%. That's pretty healthy.
Very healthy. It shows those internal changes, the efficiency drives. They're actually hitting the bottom line. It's not just talk.
So the small operational beat plus this much, let's say, cleaner cash outlook and lower spending, that's the recipe for the positive vibe.
That's it. It validates that cash-first arc management has been talking about. They're showing, not just telling.
Let's dig a bit deeper into that cash flow then. How did they achieve that?
Well, it's that mix, right? Growing EBITDA, even modestly, combined with lower capital spending, that pushed EBITDA minus capex comfortably over SE 19 billion on a rolling 12-month view.
And cash conversion improved
Significantly, up to 61%. And looking just at Q3, free cash flow was almost SEK 2.9 billion.
which importantly more than covered the dividend payment for the quarter.
About SE 2 billion, right?
Yes. And that leads to, honestly, one of the biggest milestones they flagged on the call.
Which was?
Management made a point of saying 2025 is the first year in, quite a while, that the free cash flow they generate will actually cover the entire dividend without needing to lean on more vendor financing. That's huge for credibility. Dividend sustainability has been a nagging question for Telia.
Exactly. It's proof that the turnaround plan, at least financially, is starting to work as intended.
And all that cash flow strength, that's helping the balance sheet too.
Definitely. Leverage dropped to 1.93 times on a rolling basis. And remember, their target range is 2.0x to 2.5x.
So they're actually below their target range now.
Which gives them a ton of flexibility. And it fits right into the simplification story. They're shedding non-core stuff.
Right. The TV and media sale to Schibsted closed back in July.
Yep. And they're not done. They signed an MOU that's a memorandum of understanding to get out of their Latvian stakes, TET and LMT.
Aiming for a final deal by year end.
That's the plan. A signed share purchase agreement before the year is out, so pruning the edges.
But strengthening the core at the same time, right?
Yeah.
With the Benorum deal in Sweden.
Precisely. That offer is moving ahead, expected to close Q1 next year, 2026. It's all about beefing up their main market, Sweden.
What does Benorum actually bring to the table? Is it transformative?
Not transformative, no. Think of it more as a strategic tuck-in. It gives them more scale, better capabilities in consumer broadband and related services right in their strongest territory. It fits the pattern. Divest non-core, invest smartly in the core.
Makes sense. Now, back to efficiency for a second. You mentioned the margin expansion. Is that sustainable or just some quick cost cuts?
Well, that's what analysts were pushing on. Management insisted it's structural. They pointed to resource costs down almost 3%, and OPEX as a percentage of service revenue is trending down too to 28.4%.
And they use that phrase, simpler, faster, more efficient.
They did, and they backed it up by saying combined headcount, including consultants, is down nearly 25% since the start of 2024. So they argue these are lasting changes to the cost structure.
Okay, let's switch gears to the operations, the actual engine room. It feels like a tale of two Telias here.
It often does. You got the parts that are really humming and the parts that need, let's say, some work.
Let's start with the good news. Sweden and the Baltics.
Right. Sweden continues to be the rock. Service revenue grew 2%, mostly broadband and TV doing the heavy lifting. And they keep winning customer satisfaction awards like the SKI ones. Very solid.
The broadband net adds look really strong in Sweden this quarter.
They did, but there's a little footnote there. Management was clear that about 10,000 of those ads were actually from Q2, but got registered late because of a system change.
Ah, okay. So still good underlying intake, just a timing quirk, making Q3 look extra strong.
Exactly. It's like two decent quarters swashed into one number, not one blowout quarter. Still positive, just need that context.
Got it. And the Baltics.
Still performing very well. Lithuania and Estonia both showed healthy service revenue growth. Lithuania's EBITDA was up, 9%? And cash conversion across the Baltics remains at, quote, record levels.
So yeah, the core is definitely firing on all cylinders.
Okay, now for the less sunny side. Norway and Finland. The repair jobs?
Yes. Norway is the main headache right now, no doubt. Both service revenue and EBITDA went negative year over year.
What's dragging it down? It's mainly lower mobile wholesale revenue, plus ongoing issues in the fixed line business. Management thinks service revenue might have bottomed out.
Optimistic.
But they also warned that the EBITDA decline in Q4 could be similar to what we saw in Q2 and Q3 because of how some operating expenses are timed.
Okay, but they just told us they're cutting capex overall by $1 billion SEK.
Yeah.
How are they going to fix the Norwegian fixed business accelerating fiber upgrades, new TV platform within that tighter budget? Seems like a conflict.
Yeah, that's the multi-billion krona question, isn't it? Management was quite firm on this. They insisted the faster coax to fiber upgrades will happen within the existing lower capex number.
Enough magic.
Not quite. It's about ruthless prioritization. They're basically saying we're shifting capital away from other things to focus solely on the most critical fiber rollouts in Norway that promise the best return. Everything else gets squeezed.
So it's disciplined reallocation, not new money. Okay, that makes more sense. Strategically anyway. What about Finland? That's been a turnaround story for a while.
Finland is genuinely showing signs of stabilizing. Mobile net ads were decent. Crucially, they didn't lose mobile handset customers, which is a win in that market.
And revenue per user.
ARPA, average revenue per account on mobile postpaid, grew 4%. That's solid. And profitability is improving too. EBITDA margin climbed quite a bit, up to 34.6%.
So slow and steady progress there.
Seems like it. They're ticking the boxes on their goals for Finland. Stabilize share, grow ARPA, improve profitability. It's not fixed overnight, but it's moving the right way.
Okay, so despite this mixed bag operationally strong core, lagging bits management doubled down on the 2027 targets.
They did. Fully committed, they said. That's the 2% service revenue share GR, 4% EBITDA CAR, and getting free cash flow to at least SEK 10 billion.
And I guess this quarter's results, especially the cash flow guidance, give them more credibility on hitting that FCF target, assuming the operations cooperate.
That's precisely it. The market basically said, okay, we believe you can manage the finances tightly enough. The focus now shifts purely to, can they deliver the operational turnarounds needed, especially in Norway and Finland, to generate the underlying earnings for that FCF?
Right. The financial discipline seems proven. Now it's about operational execution in the tougher spots, which is what investors will watch like hawks.
Absolutely. You heard it in the analyst questions probing the sustainability of efficiency gains, questioning the 2026-2027 capex plans.
And management's response on future capex.
Standard playbook, really. They said the discipline is here to stay, but specific numbers for 26 and 27 won't come until the January results. Everyone will be looking to see if this year's SEK 13 billion is the new ceiling.
So the overall picture is Telia is doing what other Nordic telcos are doing, pushing pricing, rolling out 5G and fiber, staying tight on spending, but they really need that Sweden-Baltic engine to keep running hot while they fix Norway and Finland.
That sums it up perfectly. The core is carrying the load for now.
All right, let's shift gears into our favorite segment. This is not financial advice. Taking what we learned today, What's an outrageous but plausible trade idea we can toss out there?
Okay, well, the setup is pretty juicy, you have to admit. Leverage is low, sitting at 1.93x below the target range. They've got the cash from the TV and media sale sitting on the balance sheet. They confirmed the progressive dividend policy, but they explicitly kicked the can down the road on any extra capital returns like big buybacks or special dividends, saying they'll talk about that early next year.
Right, so you've got the means, cash, low leverage, and a timeline, early 2026 discussion. What's the trade?
The trade idea is basically betting on a big bang capital return announcement. Specifically, you could look at, say, short-term call options, maybe expiring in Q2 2026.
Why Q2 2026?
Because the Norm acquisition in Sweden is slated to close in Q1 2026. Once that's done, the main strategic portfolio tweak is settled. Management has the cash, leverage is low, simplification is mostly complete. What else are they going to do with that firepower?
Announce a massive buyback.
Exactly. The pitch is buy calls, betting that immediately after Norm closes, maybe alongside Q1 results, they announce a really significant share buyback program to use that balance sheet capacity. The idea is this forces a re-rating, signals a strong shareholder return focus, maybe even creates a bit of a scarcity premium.
Outrageous because it relies on perfect timing and a very large buyback decision, but plausible because all the ingredients are there.
Precisely. High risk, relies on management pulling the trigger decisively, but the setup is compelling. Again, not financial advice, just connecting the dots.
A fun one to think about. Okay, let's wrap this deep dive up. Key takeaways. Q3 wasn't necessarily a huge operational beat. Adjusted EBITDA was just okay.
Right. The main story was the financial discipline kicking in hard. The free cash flow guidance got a nice boost. Capex got trimmed significantly.
Portfolio simplification is marching on. Latvia exit hopefully soon. Norway and Finland moving ahead. The balance sheet looks much healthier.
Definitely. And that brings us to the final thought for you, the listener. Telia proved its financial chops this quarter. The dividend looks secure. The core business in Sweden is strong. But the ultimate success, hitting those ambitious 2027 goals, now really boils down to one thing: execution. Can they actually turn around Norway and Finland operationally? If those markets keep lagging, all the financial discipline in the world might not be enough to hit that SEK 10 billion FCF target. That's the next big test.
Excellent summary. Thanks for joining us on the Deep Dive.